Thank you all for joining us on this week's Trending Treasury. This week we're speaking to Michael Brooks from Fitch. Thank you very much for joining us, Michael. Nice to have you on. I will just switch across to your presentation. So, registered providers. A flurry of activity at the moment. We've got clients investing in RPs through sort of RCFs and direct lending through term loans and things like that. But obviously, credit quite an important factor here. Can you just start by giving us a general overview of the registered providers and that Fitch look at?
Yeah, no problem. Michael Brooks, as Stuart mentions, from Fitch. I head up the UK team covering English registered providers and all governing. To give a quick overview, at the moment within Fitch, we rate around 20 issuers in the registered provider space, 8 of which are public based, 12 are on a private basis. And we're hoping to move more of those privates into public so we can discuss them more freely. But as you can see, the range of ratings doesn't vary too much. We're all tending to be in the A category space. The types of providers we have does vary quite a lot, though. If you're looking at someone like Origin Housing, where there are sort of 7,000 homes located in a very specific location within London and Hertfordshire, versus your basis for 100,000+ homes. So we've got sort of quite a wide portfolio, both sort of size and geographically, but doesn't tend to be that diverse in terms of ratings as ratios, in terms of financial ratios, and our assessment of revenue and operating risk tends to be similar across the board. The most recent addition to our portfolio, the public, is Platform Housing Group, who we rated in February at as you can see, at a high level, at A+, with a negative outlook reflecting that of the sovereign. And shortly after we rated them, they issued a £1 billion EMTN programme, one of 7 currently in the sector. And as Stuart mentions, it's been a flurry of activity across the whole sector. Just this morning, I've had 2 emails from investment managers asking for discussions on the sector. So we're seeing quite a hive of activity, not just now, but just over the last sort of 2 to 3 years, and it's growing more and more by the day.
Brilliant. Yeah, and I see some of the housing associations here. We have clients that have bought some of these bonds as well. So it's sort of direct lending and purchasing the bonds as well. So can you just give a brief overview of how Fitch come to get these ratings? I mean, it's sort of, there's quite a wide variety there. You've got massive housing associations and some of the smaller ones as well. So sort of what criteria go into that? So
not a problem. So we rate social housing providers using 2 criteria. What we call our master criteria for this sector is the revenue supported criteria, and the cross-sector criteria is the government related entities criteria. For registered providers, we rate on what we call a bottom-up basis. So the large majority of the strength of the credit is from their standalone basis rather than derived from the sovereign, which we consider to be their sponsor. So we use the revenue supported entities criteria to get to this standalone credit profile, and then we notch up from that using the government related entities criteria. So if we move to the next slide, Stuart, I think it's easier to show what's included within the revenue supported criteria. So the revenue supported is split out into 3 main key factors: the revenue defensibility risk, the operating risk, and the financial profile. And across these 3 areas, revenue defensibility, we're looking at the pricing risk, and we're looking at the demand side risk. So pricing, we're looking at the ability to adjust prices to increase revenue, and demand side, we're looking at concerns in terms of if there's a lack of demand. When it comes to this sector, quite often we're seeing that this is assessed as stronger. So we assess each of these factors either stronger, mid-range, or weaker. Revenue defensibility tends to be stronger. Demand always is stronger across the board, but pricing can be flexible between mid-range and stronger, depending where the entity operates, what their sort of market share is, what their operations are, whether they have considerable social and affordable, but not large amounts of market activity, not large amounts of shared ownership. That tends to be more in the mid-range, because most of the revenue is regulated. There's no ability to really change that the level of revenue. It's set based on what the regulator decides is the ability to increase that year. So we do give a little bit of positive credit for a slightly more diverse portfolio where there is that flexibility, or at least the ability to change that in the future, even if they haven't decided to do it at the moment. In terms of operating risk, that's assessed on two separate areas, which is the resource management risk, and it's more something that focuses on concerns over staffing or resources, as it would suggest. So as this criteria covers all of our public related entity criteria, public related entities, I should say, not criteria, that side is more focused on things like higher education and hospitals and charities, areas where there's much higher staff costs, much more concerns in terms of expertise within that field, areas where you can't just suddenly have more doctors or more lecturers, and concerns more towards sort of Brexit and issues with things like that. But at the moment, we assess resource management risk across the board, except for I think maybe one or two as stronger. A couple have quite considerable care attributes, where we have to consider what level of staffing costs and what there may be risks in terms of turnover and impacts of Brexit there. And overall operating risk tends to be stronger across the board. We have, I think, maybe one that isn't across the whole of our portfolio. In terms of financial profile here, we're looking at whether we look at sort of 5 years historical information from the entity, and we look at 5 years in the future. And we look at the 5 years in the future based on the entity's business case, what we call our base case scenario, and then we do our rating case, so we stress that slightly. So we bring that all together and we look at how the entity looks through the cycle. And so we're looking at specifically the key ratio we're looking at is net debt to EBITDA in this sector. And we're looking at that through the 10-year cycle, so as to smooth out any sort of peaks and troughs that may occur through that timeline. So at the moment, across the sector broadly, we tend to have stronger across the board for all three. There are a few that have slightly different attributes. I mean, some have considerable leisure management, others have considerable student accommodation, private rental, private sale. Some operate major shared ownership schemes, care schemes. So it can be quite different. So there might be slight differences, but broadly speaking, we look as quite a strong sector, and as it is quite counter-cyclical within a COVID timeline, it's seen as quite a strong, robust sector moving forward.
Brilliant, thank you. Yeah, you noted that some of the more diversified ones might be slightly stronger, but a lot of the housing associations are quite concentrated in one area, sort of like ones like London and Quadrant and some of the London-centric ones. So do you find the ones that are more geographically diversified are well, stronger in terms of credit quality, or is it sort of quite specific to each one?
So in terms of geographic area of operation, diversification in terms of geography, we don't necessarily see as a credit strength. We see more of diversification of operations. So the ability to have a development arm that, if needed, they could develop 50 units to sell in order to have more returns to reinvest in their business. So that to have a development arm to generate further revenue that could be used to cross-subsidize. So they're not entirely reliant on regulated business. So that it's not the only thing that gives credit strength, but it is an area that we do look at as credit strength, to have a certain amount. Obviously, if there is a huge amount of development for sale, that suddenly makes it more like a REIT or a real estate developer, and less like an RP, and that there'd be more concerns there. It's just a certain amount to diversify the risk of what has really occurred over the last 5 years with the reduction in rental, and taking that into account. I know the next 5 years there's the ability to increase by inflation plus 1%, but taking into account the fact that it has happened in the past and the possibility that could happen again in the future, the ability to vary that downturn is seen as a positive in our credit assessment.
Brilliant, thank you very much. So sort of moving on, you've still got some more key metrics here, which in greater detail actually.
Yeah.
As you know, sort of the inflation-linked aspect is quite important, and you know, with the increases in inflation that are currently factored into the market, that's very, very important. And
yeah, just to include this slide as many people ask what sort of metrics we look at to assess strength in terms of stronger, mid-range, weaker. As I say, most of them across the board tend to be stronger. So most of these metrics do support the stronger aspect. I mean, if any of them were to look weaker, we discuss with the individual entity. For example, relet days, we've seen a massive downturn in the last 12 months, purely on the basis that there's been concerns in terms of nominations from LRGs, as LRGs have obviously been quite busy with other things going on with COVID. And so we've seen relet days increase quite significantly. We've seen quite a fluctuation in arrears month to month, and lots of changes over the last 12 months, but they began to flatten out a bit going through when there wasn't lockdowns. And I think that the initial bump that we were seeing has turned to something closer to normality. But yeah, these are just some of the ratios that we tend to use to assess strength.
Brilliant, thank you. And the spread from sort of top to bottom isn't that large actually. In terms of the ones that Fitch rate, they all seem relatively strong. Can you take us through this rating positioning table? It seems to be all relatively high.
So we've highlighted within the rating positioning table generally where we found all of the issuers that we've rated. So they all tend to be on the mid-range or stronger side of both of our key rating factors in terms of revenue defensibility assessment and operating risk. And therefore they end up in those top two lines that you can see. And then the positioning quite often comes down to the financial profile of the individual entity, which can vary quite a lot depending on how the entity was made up, what legacy issues they have, whether they were initially an LSVT that has significant legacy debt or legacy commitments in terms of financial investment, things like that can really sort of weigh on some of the ratios. If they haven't developed considerably in the last 5 years, like we've seen some entities across the sector, they've taken on the reduction in rent and just looked to reduce their expenses. Those entities we've seen have quite strong ratios. Particularly quite a few northern entities that during the downturn have looked to not develop their way out of it and not to cross-subsidise, have not borrowed as much, and therefore their ratios are at the very higher end of this scale, and at sort of the 4, 5, 6 times, which is very low in this sector. But generally across the board, we've seen quite a lot of strength in the sector, and the net debt to EBITDA rarely goes above sort of 13, 14 times, even on an individual basis, not even on a sustained basis. So that they're quite strong entities we've seen across the board, in all areas and of all sizes. Particularly, I find because the entities have to report each year to the regulator of social housing their business plan and their expectations in terms of financial viability and their in-depth assessment, quite often these ratios are considered in that sort of process, and therefore the ratios that don't tend to peak too high. Yeah,
brilliant, thank you. And well, I know you look at 5 years ahead or 3 to 5 years ahead, but would it be sensible to look a little bit further as well? I mean, these are long-term projects that they're going for. Do you take into account any other aspects, sort of longer term?
So we look historically 5 years and 5 years in the future. So we try and have a 10-year horizon with sort of 5 years of actuals. So we try not to look beyond 5 years as we think beyond 5 years as regulation can change within, well, certainly as we've seen over the last 5 years, regulation is an ongoing change, particularly in terms of fire safety, environmental changes, rent reductions and now rent increases. Beyond 5 years, we think the certainty of expectation isn't necessarily there, even though they're fairly solid, robust entities that are quite predictable in terms of cash flows. We still expect cash flows to continue. We still expect them to be at a significant level, but beyond 5 years, we don't know whether it will continue to be inflation plus 1%. We don't know whether they will continue to be allowed to develop for sale. We don't know whether they'll continue to be the same level of grant provided by Homes England. And so at the moment, we try to look at 5 years in the future. And I know that quite a lot of investment firms we speak with are looking to invest to hold, as it's got quite a nice long-term maturity. But at the moment, this tends to be our rating as government-related entities.
Brilliant, thank you. So moving on to the government-related sort of entities, yeah, talk us through your criteria here.
So all I've spoken about at the moment is what we call the standalone credit profile that gives you the bottom-up, essentially. So the notching increase that we get from the government-related entities aspect comes through our government-related entities criteria. So we're looking here at that there's two sides to it. Another is then split down into status, ownership and control, and support expectations on one side, and then socio-political implications and financial implications of default on the other side. And so we assess each of these factors as either what we call weak, moderate, strong, or very strong, and they each result in a numeric outcome. And the overall outcome for this sector has been 12.5. We've assessed this on an individual entity basis. We've assessed this on a portfolio basis, and each time it's been agreed that the approach still remains correct. The latest portfolio review we did was October, where we looked at all of our entities and decided that the approach still remained correct to have 12.5 as the overall outcome, as the entities are not owned by the government. They are supported, they're well supported. We still think they will be well supported moving forwards in terms of certainly capital grant funding through universal credit and housing benefit, but also the structure through the regulator that is provided, particularly financial and governance viability, the powers that the regulator has in terms of if there's a possibility of a default or any concerns moving forwards. So we think there's quite a strong structure and expectation of continuing operations in the sector and support from both the sovereign, local, regional governments. 0.5 assessment, which gives us generally across the board a bottom-up +1 assessment. This, when the sovereign was downgraded last year, brought a new sort of aspect to it, which is it is a bottom-up +1 capped at the sovereign -1, which is why you'll see quite a lot of our public entities with a negative outlook, as the UK sovereign was placed at AA- with a negative outlook last year, and several of the entities and now with the bottom-up +1, one notch away from the sovereign at A+, and therefore their outlook reflects that of the sovereign. So there's a few that have had that assessment at the moment, but generally it is bottom-up +1.
Brilliant. And you touched on the governance and viability ratings there. Do you find that they generally match up with your ratings there? The government viability ratings match up with the registered providers ratings there? So
the governance and viability ratings we look at as an indicator if there's any concern rather than necessarily a strength. So as long as they remain within the G1, G2, V1, V2 ratings, and what's considered compliant by the regulator, we only really rate as to why, or if there's any concerns from the regulator, why there's concerns. Because as long as they're compliant, usually there's a good reason why they're G2 or V2. Quite often V2s are linked to significant development schemes, which is encouraged by Homes England and encouraged by the regulator, but the regulator feels necessary to recognise that there is that risk there in terms of development. In terms of governance, sometimes it may be due to a recent merger, sometimes it's even due to actually self-reporting. If they've recognised, oh, we found a flaw in something we've done, and they can self-report, and quite often, sadly for them, it does involve resulting in a downgrade, but seen as actually a positive because they're seen as quite transparent. So as long as they remain within those parameters, if it went below those, we'd have a concern, and that's when we'd start considering whether it has an impact on the overall credit.
Brilliant, yeah, and transparency, in my view, is always a good thing, even if it does result in a downgrade. Can you talk us through the key issues and challenges facing the sector at the moment?
So we've got a couple of slides coming up entirely on COVID, as I think this is one of the main questions we get asked in the last 12 months. Realistically, the sector's performed very well during COVID. It's been fairly robust. We've seen those with sort of significant care attributes have slightly increased in terms of stuff and PPE, but not significant enough to really impact our overall business. And we've also seen that whilst there is some dips in terms of vacancies, that there is a few more vacancies. Actually, since the first lockdown, this has been less of an issue. The first lockdown really had a lot of uncertainty, but since then, there's been a lot of measures put in place, and we've seen returns to what's looking more like normality. And pretty much all actually are still working from home. Many haven't even reopened their offices. Many are considering not reopening some of their offices. We're seeing that possible divestment from their office space or break clauses within leases being exercised, more home working within the sector, reducing costs, so they're seeing it as a positive. We did see initially some increases in arrears and in voids and in bad debt, but this has smoothed out throughout the year, certainly between sort of furloughing and UC being quite a stronger process now than it was in the past. There were significant delays in the past with the provision of UC, but throughout the year, considering the number of people who've had to move onto UC, it's been in quite fast flowing. There hasn't been the increase in arrears that we'd have expected from that, because usually there's a 6-week delay generally, but we haven't really been seeing that. There has been delays in the development program, but that has also allowed some of our providers to reassess what their development program looks like going forwards. So some have decided to scale back their development programs as a result of this. And the main impact of this is just moving cash flows from year to year. So most of them that develop for sell off plan or are able to sell almost immediately as completion, so that there isn't really concerns about buildup of stock, as there tends to not be huge numbers developed for sale. The regulator, again, was supportive, as we've seen across the last 5-10 years, allowing extra time to provide their financial plans, which was definitely a positive. We saw quite a few financial plans around this time last year, April, May, and what was seen then and what was seen in September was a world of difference. There was so many provisions being put into the initial plans that weren't realised, and so that was really quite supportive of the RSH, because I think there could have been wholesale downgrades of financial viability had they seen those initial plans, but in actuality that none of that came to fruition. Just seeing if there's anything else that's worth mentioning. Just seen a very strong performance still across the sector, as it is counter-cyclical sector. There's increased demand, as sadly as more and more people lose their jobs or move on to furlough, they're looking for more and more affordable and social housing, and so the demand is increasing.
Brilliant, thank you. And yeah, you noted earlier that some of the northern housing associations haven't taken on as much debt, but do you find that alternatively some of the London-based ones or southern ones have taken on significantly more debt? Is that a trend that you've been seeing?
The southern housing associations, I think, tend to have a bit more debt within their portfolio, but they also tend to have higher value assets that are securitized against the debt. The northern housing associations, we're seeing moving forwards now and starting to take on more private placements, more public issuances. In the media recently, there has been quite a few that have done public issuances, and I think they're starting to move forward. It depends what approach the entity has decided to take. That there was very much a differential approach across the board when the rent reduction came in. Some focused on reducing costs, some focused on increasing rent, and we found many northern housing associations focused on reducing costs and keeping within their core remit and keeping their core activities ongoing. Some of the more southern Midland housing associations looked more to development, the sale market, rental, care activities to boost revenues in other ways. And as I say, not necessarily broad brush, there can be differences depending on which entity decided which way, but more than likely due to property price being able to develop for sale and having the returns that they can access. Whereas in the north, there tends to be a smaller differentiation between affordable and social rental costs, and therefore some of our strongest credits are from northern housing associations as well. So it's just showing that different approaches that can be taken depending on what the entity decides.
Brilliant. Well, I'll just open up the floor to anyone. If anyone has any questions, please pop them in the chat box, and we'll sort of try and address them here. Yeah, well, it's quite interesting that you have quite a narrow field for sort of both your public and your private ratings. Do you have quite a lot of housing associations coming to you, sort of inquiring, oh, should we get a rating? Is that sort of a pipeline that you have?
So we've currently got 2 more housing associations that have given us what we call a notice to commence work. So we'll be issuing 2 new ratings within the next 6 to 8 weeks. And we've got a pipeline of interested parties who we're in ongoing conversations with. So it's certainly a sector that's not quieting down. We spoke to quite a few housing associations last year relating to the corporate COVID facility. I mean, the issue with that was the continuing changing government guidelines when it came to who could access that, and the G1, V1 size of the issuer, things like that. We ended up rating a few for that, doing short-term credit opinions, but yeah, there's continuing interest from the sector. We expect the portfolio to continue growing.
Fantastic, yeah, and that's sort of good news for everyone, really, in that local authorities are increasing their investments in social housing and RPs through the deals that I mentioned, like RCFs and direct lending. So it's brilliant to hear. Thank you very much. We've not had any questions in the chat box, so we'll bring it to an end there. Thank you very much for joining us, Michael. It's been quite insightful. If any clients on the call do have any questions on housing associations and RPs in general, please send us an email, or if you have any questions for Michael, please get in contact. Thank you very much for joining us. Next week, we will have Schroders talking to us about value investing through the pandemic. So please join us again next week.
Thank you very much, everyone.